Here's a summary of UnitedHealth Group's UNH Q2 2025 earnings call, focusing on key financial metrics, management commentary, and outlook. Overall financial performance. UnitedHealth Group reported Q2 2025 revenues of nearly $112 billion, an increase of 13% year-over-year, driven by growth in both UnitedHealthcare and Optum. However, adjusted earnings per share of $4.08 were lower than the prior year. This shortfall is primarily attributed to higher than anticipated medical costs and pricing assumptions that fell short of actual medical expenditures. Key financial metrics and factors. Revenue, $112 billion, up 13% YOY. Adjusted EPS, $4.08, down from prior year. Medical costs. UnitedHealthcare's total medical costs for 2025 are now projected to be $6.5 billion higher than initially forecasted. Medicare. $3.6 billion of this increase is in the Medicare portfolio. Medical cost trend for Medicare Advantage is now expected to be 7.5% for the full year 2025, up from an initial assumption of just over 5%. Medicare Supplement trend is also elevated at over 11%. Commercial. $2.3 billion of the increase is in commercial business, ACA and employer. Commercial trends are approaching 11% in some areas, such as group fully insured. Medicaid. Trend pressure is also present in Medicaid, particularly in behavioral health, where trends are running at 20%. Optum Health shortfall. Optum Health earnings are approximately $6.6 billion below expectations for 2025. This is driven by value-based care, $3.6 billion shortfall, attributed to enrollment mix, more complex patients, accelerated medical trend, and underestimation of new member risk. Discontinued portfolio actions, $2 billion reduction from paused actions. Other items, $1 billion from lower service volumes, prior period impacts, and slower acquisitions. Discrete items. The company recognized approximately $1.2 billion in discrete items in Q2 2025, including unfavorable impacts on ACA exchange offerings, establishment of a premium deficiency reserve, and settlements of outstanding disputes. The full-year outlook accommodates an additional $1 billion in potential settlement items. Medical care ratio, MCR. The full-year 2025 MCR is now projected at 89.25% plus or minus 0.25%, a significant increase from the initial 86.5% midpoint. The second half MCR is expected to be just under 91.5%, with Q4 being the highest. Cash flow. Full year 2025 cash flows from operations are expected to be about $16 billion. Tax rate. The full year tax rate is estimated at 18.5%. Management's forecasts and outlook. 2025 full year outlook. Adjusted earnings are projected to be at least $16 per share, with revenues approaching $448 billion. 2026 outlook. UnitedHealthcare, UHC4 Medicare Advantage. The company aims for a margin in the lower half of its targeted 2 to 4% range in 2026, moving to the midpoint in 2027. This will be achieved through significant benefit reductions and plan exits, affecting over 600,000 members, primarily in PPO offerings, to account for continued cost trends and funding pressures. Commercial business will see pricing to anticipate higher trends, with potential membership declines and shifts. ACA exchange participation will be more conservative, with possible market exits if necessary rates aren't achieved. Optum Health expects value-based care margins to remain consistent with the current year's 1% margin, with advancement beginning in 2027. The company plans to cease arrangements for about 200,000 PPO patients. Optum Health is targeting $1 billion in cost reductions for 2026 through operational disciplines and technology integration. OptumRx expects revenue growth of 13% and earnings growth of nearly 4%, driven by low-margin specialty drugs. However, earnings growth is constrained by factors like the removal of portfolio actions, private label business launch, and GLP-1 impacts. OptumInsight, facing a $1 billion downward adjustment in outlook due to a slower-than-expected recovery post-cyber attack and pausing portfolio actions. Long-term growth. Management anticipates a steady return to low double-digit EPS growth rates over time, with strengthening in 2027 and beyond. This is supported by organic growth, productivity gains, capital allocation, and business model evolution. Long-term margins. Optum Health. Long-term margins are now seen in the 6 to 8% range, with value-based care specifically targeted at 5%. UnitedHealthcare. Target margin ranges remain unchanged. Medicare Advantage, 2-4%. Commercial, 7 to 9%. Significant risk factors. Elevated medical cost trends, intensifying service intensity per encounter, higher utilization, and more aggressive provider coding and billing are the primary drivers of financial pressure. Regulatory and funding changes. Generational pullback in Medicare funding, potential contraction in Medicaid and exchange markets, and ongoing public controversy over managed care practices pose risks. Operational mistakes. Management acknowledges pricing and operational errors, which are undergoing review and remediation. Cybersecurity. The lingering impact of a previous cyber attack on OptumInsight. V28 headwinds. The industry-wide shift to V28 is creating a significant headwind for Optum Health, estimated at $7 billion through 2025. Enrollment mix and new patients. In Optum Health's value-based care, new, complex, and underserved patients are contributing to negative initial margins. Highlights. Revenue growth. Achieve strong double-digit revenue growth across the enterprise. Employee dedication. Acknowledgement of employee commitment during a challenging period. Commitment to reform. Strong emphasis on cultural shift, transparency, and stakeholder engagement. AI investment. Accelerating investments in AI across the enterprise to drive efficiency and product development. Operational review. Intensive review of businesses and management practices to improve performance. OptumRx performance continues to see strong revenue growth and high client retention. Lowlights. Significant medical cost miss. Underestimating medical cost trends is the primary driver of financial underperformance. Optum Health underperformance. Substantial earnings shortfall in Optum Health, particularly in value-based care. ACA exchange losses. Recognition of unfavorable impacts and establishment of a premium deficiency reserve in ACA offerings. Delayed portfolio actions. Decision to pause certain portfolio actions, impacting expected financial benefits. Reputational management. Addressing public controversy and rebuilding trust with stakeholders. Most important statements from CEO Stephen Hensley and CFO John Rex. CEO Stephen Hensley emphasized a tone of change and reform, born out of recommitment to the mission of healthier lives and a better healthcare system. Acknowledged that some require fundamental reorientation, and that mistakes have been made, particularly in pricing and operations. Highlighted a cultural shift in our relationship with regulators and all external stakeholders, aiming for proactive, constructive, and responsive engagement. Stated the intention to reposition the enterprise as a far more modern, reliable, consumer and provider-friendly enterprise using new technology and approaches. Acknowledged the challenging environment, including Medicare funding pullbacks, unprecedented medical cost trends, and increased provider coding/billing. Assured stakeholders that all the foregoing is fully addressable and performance can be restored. Projected solid but moderate earnings growth for 2026 and strengthening growth in 2027 and beyond. Reiterated the commitment to rebuilding trust through increased transparency, with independent experts overseeing reviews of key policies and practices. CFO John Rex confirmed that the primary driver of the non-healthcare earnings shortfall for 2025 is that our pricing assumptions were well short of actual medical costs, estimating a $6.5 billion increase in medical costs. Detailed the impact on Medicare Advantage medical cost trend increasing to 7.5% and Medicare Supplement to over 11%. Explained the $1.2 billion in discrete items impacting Q2, primarily related to ACA exchange offerings and prior year settlements. Provided the full year 2025 guidance of at least $16 per share with revenues approaching $448 billion. Highlighted that the medical care ratio is revised upward to 89.25% for the full year. Stated that for 2026, UHC aims to be in the closer to the midpoint of the range for Medicare Advantage margins, 2.5 to 3%, after implementing benefit cuts and plan changes. Acknowledged the challenging year, but expressed confidence in the team's ability to regain intensity, precision, and executional disciplines. In summary, UnitedHealth Group is navigating a challenging quarter marked by significant increases in medical costs and operational missteps, particularly impacting its UnitedHealthcare and Optum Health segments. The company is undertaking a broad reform and reorientation effort, focusing on enhanced transparency, operational rigor, and strategic pricing adjustments to restore performance and confidence, with a cautiously optimistic outlook for gradual recovery and long-term growth.